Time now to take a look at the markets picture over in Kenya. Let's recap first on the trading day that was on Friday. We had the Kenyan markets see the NSE 20 share index rise for the first time since April the 11th on Friday, trading 0.4% higher by the close. We had the market dipping back, remember, as investors took profit on a post-vote rally. But now traders saying that most counters are oversold and investors are seeking to re-enter at low prices. Just taking a look at the markets overall, that index easing 1.7% week on week to 4,785.3 points. In the meantime, we had telecoms provider Safaricom, the most traded stock on the Nairobi bourse, rising 0.8% to 6 shillings 65 as investors piled into its shares, and that ahead of full year results on May the 14th. The share price here touched an almost 5-year high of 6 shillings 70 during the session and is up about 31% so far this year. In the meantime, on the currency front, the Kenyan shilling dipped on Friday, weighed down by dollar demand from importers and banks covering their positions before the weekend. But traders said that the shilling could firm this week, aided by foreign investors selling dollars to pay for bonds bid for at an auction last Wednesday. So with some good flows expected to come into the bond market this week, where payment for the bond is due today, the unit for now trading pretty flat at the 83.80 mark. Just to note, the shilling is 2.8% stronger against the dollar so far this year. Let's get into some analysis of the markets right now, and joining us for a look at it is Francis Mwangi. He's head of research at Standard Investment Bank. Francis, thanks so much for joining us this morning. Well, if you're looking at things on a week-on-week basis, we had the NSE 20 share index easing back 1.7%, but that performance on Friday seeming to be a bit encouraging, with a turn coming through and the NSE trading in the green.
Yes, good morning. Yeah, my comment on that would be yes. Of the last, let's say, 3 weeks, we've seen the market being weaker. But yeah, Friday we saw a bit of a pickup. The interesting thing to note about it is that majority of the trading and selling is coming from your local retail investors. So your foreign institutional investors who are sitting on 30% and above in dollar terms returns are still holding their positions.
Take us through your investment strategy at this stage, Francis, and where you're seeing value, because as I highlighted a little earlier, we've had investors saying that to a large extent, a lot of the counters on the local bourse have been heavily sold off, and we're now sitting in undervalued territory on most fronts.
Well, I wouldn't say on our side we are seeing as the market being completely oversold. Because, for instance, if I look at the key sector on the Nairobi Stock Exchange, is the banking sector. Banking sector stocks are still trading at average price to books of 2.3, 2.4 times, considering to where they were trading towards end of last year at averages of 1.8 times. So to us, in that regard, we're still thinking the market still has a bit of space to go. And speaking with management, we've had a chance to speak with majority of the management, both in the manufacturing space and the banking space. And majority of them are still guiding for a weaker first quarter 2013 numbers. So if I combine that with where a majority of the multiples are sitting in, a weaker first quarter, then I do believe quite a number of the stocks still have a ways to go down before we can say they have bottomed out and it's an opportunity to start buying in.
Let's take a look at to what extent that holds true for a player like Safaricom. We had Safaricom's total market valuation surpassing the $3 billion mark on Friday, making it the first Kenyan firm to ever cross that threshold. What do you make of valuations on that front?
Well, on Safaricom, if you look at Safaricom and compare it against the other listed telecoms, be it in Senegal or across Africa, in terms of an EV/EBITDA, it still looks attractive. And I think the other way of looking at it is the NSE has performed fairly well since mid last year to date. And the reason why it's been performing that well is because we've seen a lot of interest from new funds. And when the new funds come into the market, obviously the most attractive counters to them would be the most liquid counters. And in that regard, then Safaricom tends to benefit in terms of inflows coming into the market. And that is what is sustaining the price at around 6.65.
And liquidity issues also having an effect on the kind of companies that are being attracted to list, to launch IPOs on the NSE, it seems as well, Francis, because we've just heard this morning that Sudan's Kenana plans to raise $200 million on the Johannesburg Stock Exchange next year via an IPO on this end. And it's very interesting that the company is choosing the JSE as its listing avenue as opposed to the NSE.
Well, I would say possibly the reason why they're looking at JSE instead of the NSE would be, first of all, the size of the offering. Because if I look back at the rights issues that the market did see in Kenya in 2012, apart from the banking stocks that were all oversubscribed, something like Kenya Airways that was raising nearly a similar amount, around $450 million, was not well received in the market. So I would argue that the reason why Kenana possibly is looking at JSE is because of that element of not being too sure if it would be able to raise that amount of capital through the NSE as it is today.
Well, how do you see the NSE working to address liquidity issues on its end? What kind of mechanisms, Francis, are being introduced by the regulatory body on that end?
Well, on the listed counters, I would say on my side, I've not seen any strong push to improve liquidity. Because, for instance, if you look at the 10 top companies in terms of market cap at the NSE, majority of them are multinationals and majority of them have strong anchor shareholders. So if I look at how the market has traded over the last 5 years and the 75% foreign ownership cap on all listed companies, then majority of the companies are trading at 75% at the limit of foreign ownership. So I'm yet to see any strong push from the regulator or the market to improve liquidity. But on the other side, on new offerings in the market, I think the regulator has been trying to entice companies to float new shares in the market.
Mm-hmm. We've certainly heard that encouragement come through, especially for the retailers. We know that Uchumi Supermarkets is just one of the retailers listed on the NSE, despite the kind of appeal that investors are putting on the table for investors out there. If we're taking a look at Nation Media Group very quickly, making headlines this morning saying that it's planning to invest $20 million in a new printing press as part of a plan on its end to expand its print business. What do you make of that news that's filtered through?
Well, if you look at the print business across East Africa, it's become very, very competitive. We have seen majority of the players moving away from just doing their dailies to actually introducing weekly and bi-weekly papers. So I would say it's an issue of increased competition and the printing companies trying to segment the market. So venture more into the magazine market and the not so regular printing business. And that has kind of pushed Nation Media and even Standard to introduce new papers in the market.
Mm-hmm. Would you be buying into a business like Nation Media Group right now?
Well, currently, if I look at the dynamics in the industry, I would say it's something I would be holding back on because there's no significant competitive advantage in the print media as it is today in the Kenyan market or even across the East African market. If I look at the amount of investment that needs to go into the businesses over the next number of years to balance between the competition between digital media and print media, again, I'd say the investment in those businesses should ideally be high. So if I look at a company or an industry where no single player has any competitive advantage and need for reinvestment remains high, then I would say it's not a strong candidate for buying at the current moment.